Okay. So today's session, we'll be sharing our property portfolio, what we did in the past, what we have at the present, and what we intend to do in the future. More than just simply telling what we have, we also would like to share the whole thought process, the mindset behind our portfolio planning journey, our investment journey, because while we focus a lot on research, data, facts and figures, the logical part to things in our channel, we feel what is very much lacking in the sharings basically on YouTube, the sharings in the market is on the mindset to things, the mindset of purchasers, property purchases, the mindset of real estate purchases, and it's all the more important today with the market moving at such a fast pace and with people really not knowing what exactly is happening in the market. Yeah. So as usual, also we are starting with recent news. So the most recent news, the one that's got everybody shocked. I mean, even us shocked, right? Is the Pasir Ris 8 launch over the weekend. So while I wouldn't say I was surprised by the take-up rate, right, the 85% take-up rate of Pasir Ris 8, I would say what surprised me was the eventual PSF that was achieved at that development at 2,000 PSF. And 2,000 PSF was not for a one-bedder, it was actually for a two-bedder. If you read the article, which is available on our Facebook page, there was a two-bedder that was transacted at $1.5 million. So that is a 700 square feet two-bedder in Pasir Ris that was transacted at 1.5 million. And for somebody that's in the market has seen the high PSS, that's honestly quite a shocker to us as well. So, but we did. While we didn't exactly predict it hitting the 2,000 PSF, we did predict how aggressive the developers would have been. Yeah, in our video done earlier this year about the 3 things we like and don't like about Pasir Ris 8. So like one of basically the very first thing that we highlighted that we did not like was the timing of the launch, because the market is moving so quickly at this point in time. Developer stock is coming down so quickly, there being not many options, there being huge pent-up demand. The ball really is in the developer's court to do what they want to do. So we've also seen comments on Facebook. With I saw this somebody posting it on his own Facebook page about how they queued up for 2 hours. They went down in the morning expecting to pay $1.2 million for the two-bedder, and then ended up paying $1.5 million for the two-bedder later on in the evening, with the developers raising the prices 6 times during the launch. So this is something that is not new to the market. Yeah, it's not new to the market. While the PSF is new, 2,000 for Pasir Ris is not something that's new to the market. So if you want to see what else we predicted, how accurate was our predictions for Pasir Ris 8, you could check out our video. I'm going to put in the link in the description, in the comments. Do check it out. And then since we are on accurate predictions, let's also see how accurate our predictions are for the upcoming launch at Bartley View. So the video is just out earlier this week. So check it out. Let me know what you think. It's in the same format as what we did for Pasir Ris 8 and as what we did for One North Eden, Normanton Park. So since we are on the topic of accurate predictions, you probably want to check it out if you want to see what you're going to expect from Bartley View. Next up, so like when I said that this wasn't new, developers being aggressive in during a launch, high take-up rates during a launch, it's because we've seen it all before, and it was just 3 years before at Twin View. And scarily enough, the take-up rate was exactly the same at 85%. Exactly the same, as uncanny, as scary as it is. 85%, exactly the same. So I've also highlighted what some of the analysts were saying. It sounds very, very similar because over at Twinville, CDL bought the plot, which is today's Worcester Grand, at a much higher PSF. So people are taking those future PSFs as reference to existing launches, the value in existing launches, right? I'm going to touch on that later on as well. So very, very scary in terms of the uncanny resemblance of these two events. So like you can see, right? 85%, 3 years apart. Okay, and the similarities in what is happening in the market today doesn't stop there, as you can see with the next chart as well. So it's deja vu times 2. And this one I highlighted in I believe it was the June Facebook Live, about how the government is noticing what is happening in the market, and noticing that the supply is not enough, which is why they're increasing the supply. So wow, if you just simply read the headline, increasing the supply by 25%, because I had clients coming to me and being quite concerned that the land supply comes up, basic economics, if high supply and demand is not high enough, the prices will drop. But if you really go and look at the data, this increase is nowhere near enough. So for those who are new to the channel, we love to use supply factors to forecast the market. Why? Because supply, especially in real estate, is very, very inelastic. You cannot supply and you cannot have houses appear out of nowhere. You have to sell the land today to feed the demand 3 to 4 years down the road. And the huge challenge the government is facing today is that with COVID making everything so uncertain, they really do not know, even if they put out the land today, when are they expecting that supply to come online. Over at the HDB side, they are forecasting it to take 6 to 7 years to get that supply online. So this is creating a lot of uncertainties in the market, and it's making it absolute hell for the regulators to try to manage this. So and they have, even without COVID, they have had trouble managing this whole supply thing, as we can see later on, right, in our example. So the government just cannot seem to get this whole supply thing right, and that creates gaps in the market for those who know how to analyze. And for those of you who follow us on a consistent basis, you know how much we love to analyze supply charts and the gaps that we are spotting. So stay on with us, and I'm going to point out to you those gaps later on as well, the gaps that we ourselves use in our own portfolio planning. And of course, we cannot talk about, right, deja vu, we cannot talk about similarities with what is happening in the market without addressing the elephant in the room. The previous 16, 17, 18 cycle cumulated with the property cooling measures on 5th July 2018, resulting in the rush that we see over here. So I talk in detail about what we think about the cooling measures, how we feel that it's going to affect the market. So if you want to understand cooling measures and our thoughts about cooling measures a little bit more, we are also going to put the link in the description below of our sharing for the cooling measures. So do check that out. It's going to be a lot more relevant today than when we did it in May. So, of course, the question everybody will be asking us for sure is, what do we think is going to happen? Do we expect there to be cooling measures? So I'm going to go out on a limb, and based on the information that we have today, I'm putting out my prediction at 60-40, with 60% being no and 40% being yes. So I'm weighing more towards no. Why? Because of the significant difference in supply today versus where it was in 2018. So follow me. In 2018, when the cooling measures came, there was a huge amount of supply coming onto the market due to the en bloc sales. So the prices were shooting up together with huge supply coming online. And so at the high prices, the developers also took advantage of the market being very, very hot and pushing the prices up significantly. But today, there isn't a lot of upcoming supply that we have. Later on, I'm going to share with you with the TOP supply chart. And then it's going to be a lot more evident. So there's, of course, right, even though the government have increased the supply by 25%, as you have seen in the previous article, in my opinion, it's not enough. And we are also almost through, the developer existing stock has dipped below the 20,000 mark, which was the marker the last time when over in 2016, when the developer stock dipped below 20,000, it kick-started the whole en bloc rush. But today, we have dipped below it, and the developers are still quite conservative and not daring to come into the en bloc market. So it's key for us to remember why the government implements cooling measures. It is to avoid huge swing in prices. They don't want prices to go up very, very quickly and then drop very, very quickly. So it is to prevent swings. It is not intended to cause the swing. Okay, I repeat again. It's intended to prevent swings and not to cause swings. So it's not the government's intention to crash the market. So again, right, in 2018, they were afraid of the huge incoming supply, and if the prices shoot up significantly out of the reach of Singaporeans, or if it shoots up very, very quickly and the developers cannot clear those stock, then they start cutting prices. So that's going to create a price chart that goes up significantly and drops significantly. And that is going to put, at the end of the day, the consumers and the buyers at risk. So today, right, there is no fear of that oversupply coming online. As a matter of fact, there's going to be an undersupply. So you might argue that the government can try to implement a cooling measure to hold back the demand while supply slowly comes back online. But it's going to be a very tricky thing for the government to do, because if the pent-up demand floods back even stronger later on, that's still going to cause that huge swing. So which is why I said earlier, they're in a really big conundrum at this point in time. So my analogy is like a swing at the spring at this point in time. So with COVID delays, right, forcing demand in, right, then lack of supply, again squeezing the spring again, a huge number of HDB MOPs, again squeezing that spring. So this spring is now severely compressed. Another cooling measure come online that's going to squeeze the spring even more, because like we said in our sharing, cooling measures are meant to put a pause on demand and not remove demand from the market. It did remove demand from the market in 2013 when the whole ABSD, TDSR came about to suck out speculators from the market. But today, there's very, very little speculators in the market. So if you ask me, will new cooling measures destroy demand? The answer is no. It puts a pause on demand. Okay? So, right, before I move on to the next slide, right, if this whole cooling measure thing is the single biggest thing weighing on your mind and holding you back from a purchase, then I would say you're not planning your purchase right. So if planning is done correctly, and something that we tell all our clients, if you buy today and cooling measures come tomorrow, you think that you will be very stressed out, you will lose sleep over it, then you aren't ready to buy. You haven't done sufficient planning to buy. So if you buy today and cooling measures really come tomorrow, you shouldn't be worried. Then in that case, means you have done your planning right. So how to do it the right way? Just stick out with us, later I share with you how. So next slide. So this is the next big piece of news, the new land sales, and I probably think that this was the precursor that led to the whole Pasir Ris 8 bonanza, because people are seeing what the estimated sale prices will be like for the new supply. So what do I mean by new and old supply? Later on I'll share with you the TOP chart, and then you will understand a little bit more. So the Lentor site, right, was sold basically last week. Yeah, last week they announced the results of the tender. So Lentor OCR is going to have to sell in excess of 21,000 PSF. Tampines EC is going to have to sell in excess of 1,200 PSF. So this is with land cost and with developer break-even cost and a little bit of profit already factored inside. So just let that sink in. Just 2 years back, the previous supply, just 2 years back, what could you have bought this similar type of properties for? Let's take a look. And let me take this opportunity to have a drink also. So I've updated this chart of ours to show the recent land sale. So Lentor Central is at 1,204 PSF per plot ratio. I'm going to bring your attention to the very last line. So the Treasure at Tampines, it was launched 2 years thereabouts back. The land was bought 2 to 3 years, about 3 years back. That land cost was 676 PSF per plot ratio. So it has basically doubled because they are both in the OCR. Claiborne is also in the OCR. That was at 788 just about 1.5 years back. So it's almost like the average transacted PSF is just 190 PSF difference from the land cost over at Lentor Central. And people are starting to realize this, and that is why the demand is then flocking back into the previous batch of supply that we see. So comparing apples to apples, that's what you see. You want to compare, you can also compare the fact that Lentor Central at 1,204 PSF per plot ratio, the land cost is even higher than that of Copa at Newton, which is in the CCR. So this is OCR versus CCR. The land cost is basically the same. So future supply, the future benchmark prices have been set, and that is where we are headed to. So moving on to the next slide. So let me use this chart to illustrate a little bit on the progression of land costs. So we have seen the upcoming supply. So the upcoming supply for Lentor, it will be basically out of the screen that we see over here after 2025. So you see these two, it went up in 14, 15, 16, and then it came down. And then it came up again in 22, 23, 24, then it come down. So it will eventually come up again in 26, 27, 28. As once the manpower shortage is filled up, COVID is over, the government will ramp up supply again. So supply charts is always like that, going up, coming down, going up, coming down. So the previous peak in supply 14, 15, 16, just for reference, I picked out Park Vera, which is in Hougang. So the land cost for Park Vera, so on your left side, the left peak is at $339 $339 per square feet per plot ratio. Okay, 339. So that was the first peak on the extreme left that you see. Then the second peak, right, the peak at 222324, we use Treasure at Tampines because it's going to TOP in 2022-2023. So that one, the land cost 678. So we went from 339, the previous peak, to 676, the current peak, and the future peak, land tour that we saw was 1,200. So it's quite scary in the sense that it's basically doubling lah, from 300 to 600, from 600 to 1,200. So every time a supply gets absorbed up, when the new supply comes online, it's always at a new price. And once this new supply gets absorbed up, the future supply will be at the new price. So for all of you who are listening, out in the market, looking to buy, you shouldn't be too concerned with the cooling measures, because if you wait and they don't come, the new supply is going to be a lot more expensive. Okay? So all these external factors, or this FOMO, or this doubt in the market, with the market moving so quickly, inevitably is resulting in a lot of stress. I'm actually speaking to quite a few clients at this moment that's feeling very stressed because the market is moving so quickly, and everybody can see where the future prices are at. That has already been established. When the first land sale came out at Tanah Merah, we sort of predicted this happening already, but people didn't really quite wrap their heads around that as yet. But with 𝐓𝐚𝐥𝐤 and Lentor coming up back to back, and we have Jalan Anak Bukit coming up real soon as well, people are really accepting that is going to be the new benchmark prices set lah. So, and that's causing a lot of stress. So stress and fear comes from, I would say, a lack of knowledge and a lack of a clear plan. So let me very quickly summarize why is this happening, so that you can understand and you can start creating your plan, right, which we will talk about later on. So on the macro perspective, so macro meaning outside of Singapore, the whole world, interest rates are very low, coupled with high money supply, asset prices inevitably will come up. This is very standard economic fundamentals lah. Low interest rate, high money supply, asset prices definitely will come up. But is it in a bubble? Personally, I feel we are not in a bubble. And this is once we come back into Singapore, it's because we have all the cooling measures in place. We have ABSD, we have TDSR to keep the market sustainable, to remove speculation from the market, to remove over leverage in the market. So as opposed to previous sharp rises in prices, like the one we seen pre-2013, the market is in a much better place, much more sustainable place today. We also have a lot more savings today. The overall Singapore household balance sheet is in a net cash position versus pre-2013, where it was in a net debt position. So further look within Singapore, okay, like we've seen in the population census data, there's a higher preference for private properties, and it's been the trend over the past couple of census done. There's higher earning power. Remember the one that we were sharing, about 13.9% of the population are now earning a combined household income of in excess of 20,000, a sharp increase from the previous census done just 10 years back, where the bulk of the population, or the biggest group, I wouldn't say the bulk, the biggest group was made up of people earning combined household income of just 3,000 to 5,000. It has ×4 of that. Big jump in 10 years all the way to 20,000. So this, right, and also they are coming out of their HDB MOPs because there's a huge supply of HDB MOPs over the last couple of years, and for the foreseeable future because the government have pumped out a lot of HDB supply post 2011. So all this, all in all, is a lot of the analogy that I can give is a lot of firepower, a lot of dry powder in the market at this point in time. Huge savings, huge earning power, huge profits from their HDB ready to take action into the market. So, to summarize, right, is this predictable? Actually, we have predicted this to be happening if you have followed us over, I would say, we should check. We are probably above, have crossed our 1 year anniversary of doing this whole Facebook Live thing. But is it scary? It probably is, right? But why is it scary? Is because of a lack of knowledge and a lack of a clear plan. So don't be scared. That's why we have decided to do this session. Not just to tell you how to plan, but also to share how we did it as a case study. Yeah. So let's get into it. So if you have liked the sharing done so far, right, just some advertisement time commercial break, and it's also for the YouTube algorithm. Please do help us like and subscribe and hit the bell notification button if you want to be notified of future videos that we put up. So we don't just do monthly Facebook live sharings, we also do condo reviews like the one you saw about Bartley View, which you can go and check it out. Okay, so let me just grab a sip of water and then we can go on to the actual sharing. Okay. So how do we plan? Pardon the typo. How do we plan? Okay. So for those of you who follow us, you know that we have a very deep know-how of the market. We love to use the past data, what's happening currently in the market, to forecast what's happening in the future. So like here you have seen, we use a lot of the supply chart. So the supply chart is very, very powerful because it's very easy to predict the supply in 1 to 3 years time. That one cannot change by much, and that gives you certainty in your predictions of what's going to happen in the market. So we do this not just because it's part of our job, but because we have a passion for it. We are vested in it because we are also in the market. So having a really good know-how of the market reduces, right? Like my little image over there, knowledge dispels fear. So you're doing a good job by joining us and gaining knowledge. So hopefully with more knowledge, the fear factor drops, yeah, because you have more clarity of the future. So having a very deep know-how will allow you to be able to spot patterns and gaps in the market. Again, like what we showed you in the TOP chart. So if you have this deep know-how, you can spot patterns like that. It gives you that edge. So if you know you have a certain edge in something, it also gives you confidence and in making a higher purchase, in making that little leap of faith, because you know something that other people don't. Okay, and we have consolidated that into an ebook. Later on, I will share with you how you can get that. So that one is already done, so no need to wait. So drop me a text and then I'll immediately send it over to you. The next thing that we do is that we map out our long-term goals in terms of our property. So that also gives us great clarity because we know year to year what we need to do to make sure that we are on track. Which year do we need to sell, which year do we need to buy, and based on the year we expect to buy, what is the forecasted price, so that we know how much we need to prepare for that particular purchase. So it makes things very, very clear, it makes the goals very, very objective. So then, of course, one of the last things that we do, also very, very important, is to have a contingency plan. And this is all the more important today because nobody knows what's going to happen next month. This whole COVID thing has made the need of a contingency plan all the more important. Okay, so that is the gist of it. Let me share with you now on the execution part of it. Okay, so this is our portfolio. We bought 𝐜𝐴, which is located near Chinese Gardens, right? Lakeside, in between Lakeside and Chinese Gardens MRT. Okay, we have never stayed there a single night in our lives. That's a single night that we owned it, so I'm not terribly sure about the location also. So it was a pure investment that we bought in 2016. We sold it late last year and it completed earlier this year. It was a 2+ study. Later on I will share with you the numbers behind it and what are some of the learning points that we learned through the purchase. And there's a lot of things that we learned through that purchase on top of what we do day to day as agents. So which was one of the big reasons why we decided to do this sharing lah, because while there's a lot of things that we learn as agents, there's also a lot of things we learn in our own sale and purchase, so we want to merge that together to value add to our listeners. So what we own currently is a Park Esta 3-bedroom premium. So again, later on we will share the whole thought process that we went through to plan for that purchase, and what we hope to achieve in the future. That long-term goal that we have is to purchase a landed property. So this is our purchase at 𝐜𝐴, the actual unit. It was 0902, so like I said, full 100% transparency. You can check this up in whatever public portals that you have. So we bought it in 2016 at 1.02 million. Bearing in mind at that point in time, a funny story, Elizabeth is not here. When we told our parents that we were looking to buy a lakeside property, a property in Jurong, and Elizabeth and myself, we stay in the east. And so that purchase being a 2+ study at 1.1 million, 1,200 PSFs, the reaction that we got from our parents was a lot of shock and a lot of bewildered. Yeah, they were bewildered. I said, why do you want to buy that? And isn't it crazy expensive? 2016, where there was still actually quite a lot of uncertainty in the market. The market is nowhere near where it is like today. So, but we did our research, yeah. We bought into the whole Jurong Lakeside transformation. At that point in time, there was still the high-speed rail, which is no more. But thankfully, the investment still turned out pretty well. And I will share later on what are some of the things that helped us make it right, despite the cancellation of the high-speed rail. So we bought it at 1.02 million. We sold it at 1.28 million. Okay, so it will look like a profit of 180k, but I net off the stamp duties, I net off the agent fees, because we had a co-broke agent involved. And so the approximate net profit was 137,000. The approximate return on equity, so how do you calculate return on equity? Is the profit divided by the capital that we pumped in. So it was around 200, and let me see if I have that calculation still. Yeah, we put in about 250,000, 248,000, 250,000. So I included the 20% down payment at the start and also the stamp duty payments. So it's money out from pocket. So money that you collect versus money out from pocket. So that gives you approximate return on equity of 55% over 5 years, and that works out to 11% per annum. So pretty okay about it. Elizabeth is not here today. Elizabeth thought if we had kept it a little bit longer, we could have made a lot more. I mean, you know, these kind of things, you never know. I'm pretty happy about it, right? Because by selling this, we've moved on to the next purchase. But before that, I thought what will also be interesting is to share with you some of the current data and what we learned from the current data. Okay, so I highlighted the transactions that I thought were quite interesting. So the unit that make the most money is a 4-bedder, 1172 square feet. Our friend bought it, I mean not real friend, figure of speech. Our friend bought it at 1265 PSF, sold it at 1551 PSF, 1551 PSF. So I was telling Elizabeth that they sold it at 1551 PSF, then she was a bit sian because we sold it at 1486 PSF, sub 1500. So really good profits. He made 336,000. So by far the highest annualized return at 5.1%. So this ties in line with what we mentioned in our predictions video for 2021. We have a strong conviction that large units in the OCR will outperform in terms of their investment moving forward. Okay, large units in the OCR will outperform. We have shared plenty of data in the past to illustrate that fact, and this is just another example to show you. Okay, so that is the guy that made the most money, 4-bedder. Then the second one, which is the 667 square feet. I'm highlighted this one because basically the per square feet sold was 1700 PSF. When we saw this, we also got a big shock. 1700 PSF in Lakeside. Yeah, so that's basically what I wanted to say. But he bought it very expensive. You notice 1438 PSF versus 1265 PSF for the 4-bedder and my PSF at 1280 PSF. Why so high? Later I will elaborate a little bit further on that. Then as we look down, right, to the transaction on 4th September 2020, that was for 926 square feet. So story, when we were there, actually our first choice was a 926 square feet. So that's a 3-bedroom compact. So the prices later on I will show you was really quite close, which actually made a lot of sense to get the 3-bedroom compact. But based on how it has performed, luckily, maybe because when our turn was called, it was very late in the day already. So all the 3-bedroom compacts were actually sold out. So we had no choice but to buy our stack. But you know, all things turned out well, and we ended up outperforming them in terms of the profit. So I highlighted the comparable units to ours, basically the 3 compacts, 926, 926, 926, 904 square feet ones. They all bought in, notice, at 1004, 1003, 1004, 1004. Conventional wisdom will say usually the larger units have a lower PSF than the smaller units, but you notice how I had an entry price of 1002 and they had an entry price of 1004. So I feel that is actually the main reason why they didn't make as much of a profit as myself. So why? So let me jump. Okay, so this is the floor plan and the transaction for the 4-bedroom unit, just for your reference. Yeah. One of the points I wanted to highlight was that notice when did they buy? They bought a year after launch. So a year after launch. Hold on, let me check. Maybe you can show me the comment. Yeah. So it's not necessary to buy at launch to make a profit. Case in point, bought a year after launch and still made very good profits. Yes, Keith. Correct. Yeah, large units, the 3-bedroom premium and above would be my recommendation. Okay, so this is the 3-bedroom basically that we were looking at, that we wanted to buy. I'm not sure if y'all can see. I cannot show you my cursor, but if you study the floor plan, it is a really good layout because this is a 3 compact with an enclosed kitchen and can be converted into a dual key because one of the bedrooms is tucked all the way on one side of the unit with an attached toilet. So our intention, because we were entering in at as an investor, so we were thinking, you know, if we had gotten this unit, we would convert it into a dual key lah, for higher rental yield. So, you know, but like we said, everything turned out to work in our favor. So we couldn't get this. But then again, notice that the units sold were level 8. So why? I hope that I have that. That wasn't inside. That was inside, but never mind. So over at Lakegrand, another interesting story. The developers, because I'm going to jump straight into the site plan. So you see the site over here, block 2 and block 6. So the lake is across Boon Lay Way. The units that face the lake, if they were to be above level, so there was a significant price jump from level 5 to level 6. It's a $100,000 price jump for the exact same unit. It's because from level 5 to level 6, level 5 you are on level with the MRT track, and level 6 you clear the MRT track. So it's a significant price gap. So when we saw this price, we actually told ourselves that if the units were above level 5, it didn't make sense buying them anymore because of the significant loading, and then that price difference from level 8 unit, like we can see here, was sold at 1.287. The price gap is very, very different from our purchase at 1.1 M already. But a level 5 unit was sold at 1.188. That was just 80,000 more than what we bought at. So this is something that we talked about also in a lot of our sharings. It's important to look at the price gaps between the different unit types that you are buying. So if at a 2+ study and the gap over to a proper full 3-bedroom, it's just 80,000, you ideally pick the bigger unit lah. But once it passes that, right? So personally, our threshold at that point in time was $100,000 difference, and also bearing in mind that the lower floor units were going at a significant lower price. We didn't want to go for the higher floor unit, then we dropped down to the 2+ study. So some of the things that we learned, right, thought we could share with you for some learning points. Okay, so that is us, Stack 29. At the back, we didn't take a lake facing unit. We actually chose a unit that also didn't face the pool, which was why our per square feet is so much lower than the per square feet for the units that were facing the lake. So this is another learning point. Okay. So now that we are at Lakegrand, right, I thought I could take this opportunity to use this as a case study for resale and new launch price performance. So over at Lakeside, right, some of the comparable existing condos when we bought were Caspian, Lakeshore, and Park Oasis. So they were trending, pardon me, quite a lot of charts. But if you want this for your own reference, drop me a text also. Happy to send that to you to take a look at it. So when we bought Lakegrand at 1,280 per square feet, Park Oasis and Caspian, Lakeshore, they were averaging around the $1,000 PSF, so it was a good $200 PSF differential. But today, 𝐜𝐴 has moved up to 1005, 1006, even 1007. Our good friend, 667 square feet, 1007 PSF. But 𝐜𝐴𝐿, Park Oasis and Caspian are still hovering at that 1000 PSF range lah. So it's one of a good case studies as to the outperformance of new launches versus existing properties. I will not dive into great detail on why that is happening, but if you are keen to find out, right, same, drop us a text, right? That's a discussion that we'll have separately. Similarly, I have also laid in other big developments over at the west side. I added in also Park Rivera and Centris lah. So you also notice that the new launches are outperforming that of the existing developments. But even within the existing developments, I also noticed an interesting trend. You notice how Park Oasis is actually trending up recently, but Lakeshore isn't. So interesting exercise to find out why. I haven't done it, but I did it yesterday night, and then I thought it was quite interesting. Can dive into greater detail to understand the different price performance. Maybe we will talk about this in another session, right? If you like, put down in the comments, right? Maybe we'll run a session on discussing the price performance, the difference in price performance of resale properties. Yeah. So in summary, what did we learn from our experience over at 𝐜𝐴? The timing of exit matters. Why did I say that? If I jump all the way back, right? Notice the guy that sold in 18 and the guy that sold in early 2020, okay? They do not perform as well as us, right? As a matter of fact, we actually exited a little bit earlier. So why was it a good time to exit? I'm going to bring us all the way back. Sorry, let me see when I'm headed towards. Yeah, the TOP supply, this one, this chart. Okay, we knew that it would be a good time to sell when the TOP supply is low. So that is, hopefully this can make sense to all of you. Why would somebody be paying 1005, 1006, 1007 PSF for a new development when the existing development is at 1000 PSF, 1100 PSF, right? So once we have TOP, we are both the same. Pay, and then you can collect key, and then you can move in. So obviously, the preference for buyers in that area are for newer properties, and they are willing to pay a significant premium for that because they have no choice, because the TOP supply is so low. Okay, make sense? So coming back to the points that we learned. So timing matters in an exit. Yeah. So if you exit at the time with high TOP supply, you probably wouldn't be able to charge such a significant premium over your peers because of competition. Next is layout matters. We are very fortunate, or we are very lucky. Actually, we know lah. We picked a layout with an enclosed kitchen. If you can see it, if you want to see, you can hop back onto the replay, or you can actually go and find the layout online. It's a 2+ study with an enclosed kitchen. So the next thing is the buyer profile. So who were our buyers? We only had 3 viewings for our particular unit, and we sold it with tenancy. We just entered our 2-year tenancy, and so the buyer had to wait 1.5 years to take possession of the unit. But the buyer wanted it so badly, so much, because of the good school in the vicinity. We had Rulang Primary School within 1 km. For those of you who are not staying in the West, you probably have never heard of Rulang Primary, but we love Rulang Primary because Rulang Primary basically brought us all these profits. So a good primary school in the vicinity is a major plus. Why we say that? Because our buyer was pregnant and wanted to buy the unit to put the kid into Rulang Primary in the future, and so they planned it for their own stay, which was why the enclosed kitchen method. So that was some of the points that we kind of gathered from the wholesale process. So the last point is be aware of it's a tongue twister, be aware of the premium facing premiums. So what that means, remember just now when I showed you that the river facing, the lake facing units the developers were charging them at 1,400 plus per square feet. We were able to buy at 1,280 PSF. So at the end of the day in the resale market, you got to think, why are the buyers buying in that area for? And so we realized and we knew that they would be buying there for the upside potential had the high-speed rail came into fruition. They were buying it for the school. Are they really buying it for the lake view? We don't know. We were leaning more towards no, because it's also facing the MRT and it's also facing the road, whatnot. So we didn't feel that buyers would pay that premium, and our expectation turned out right. So be aware. So while the developers may price it a certain way, and it's sort of like psychology, right? They price it more expensive, and then naturally you start to think that it is premium, and you can charge a premium, which actually is true, but the premium shrinks, as you can see from the transactions. It has shrunk from 200 PSF to just 100 PSF. So basically, the people that buy 1,200 PSF made more. Okay. Chloe. Okay, Ken. So just because you said that, right, wanted me to do price movements for resale properties, let's do that. Okay. So I'll probably do that the next sharing. Okay. So must remember to join us, Chloe. I will see you at the next sharing. Okay. Be aware of the premium facings. So what do we own currently? So today, what we own. So anyway, if any of you have questions on our whole journey in Lake Grand, right, just put it down into the questions. I'll answer them in the Q&A. So what we own currently, Park Esta. We have bought a 3-bedroom premium. We bought it in February 2020. So fresh in the memories, that's basically right before circuit breaker. We bought it at 1.72 million. It's a 1033 square feet. Premium means it comes with a utility room lah. So what was the thought process behind the purchase at Park Esta? Okay. So why we narrowed down of all the launches to Park Esta, I will explain a little bit later on. But this is our whole plan that we have set for Park Esta. You can use this template for yourself actually, right? It's very, very useful. When is your target sale date? We have targeted it to sell in 2526. Very similar in pattern to why we sold it today, during periods of low TOP. So we've learned it once, we're going to replicate it and do it again. And because you are listening, you can use it too. What's the target sale price? We are targeting at 2 million. So if it doesn't hit 2 million, we're going to continue to hold it, because we are pretty sure it will eventually hit 2 million. After all, Pasir Ris 2-bedroom already 1.5 million. There's no reason why Eunos cannot hit 2,000 PSF, right? Who are our target buyers? So we have visualized this. Ideally, we are selling to upwardly mobile HDB upgraders, probably coming from Tampines, Sengkang, Punggol. They have upgraded. So while some upgraders are focusing on size, they want to upgrade for size. There are also a group of upgraders that want to upgrade to in terms of location, they want to upgrade closer to the city center, right? So that is the group that we are targeting, and we got a 3 premium because likely they have kids, so they will need the premium. They have a helper. They are high earning, likely to be dual income. In our 13.9% group over there with 20K and above. So with 20K and above, in our last combined household income in our last session, I think we calculated it that their budget of purchase can go all the way up to 3.3, in excess of 3 million if they want to. So 2 million is an absolute bargain for them. Another group of buyers will be the D15, D16 owners who are helping their kids buy a property nearby so that they can continue to stay in close proximity to the parents, or the kids themselves want to buy to stay in close proximity to their parents lah. And we all know D15, D16, the people who stay there have the capacity to either assist their kids to make this purchase, or the kids themselves have the capacity to make this purchase on their own. So what are some of the fundamentals that we have applied in selecting Park Esta? It's near the MRT, it's basically right beside the MRT. It's located in the RCR, right? Feeding into the fact that we are targeting HDB upgraders. They are looking to upgrade in terms of location. So what we know is not a huge unit. It's the similar size as a 4-room HDB. But that's not the group that we are targeting. The groups that are upgrading for size. So that's not really the group that we are targeting. He has excellent amenities. So we are very focused that we would be selling to owner occupiers, people that are buying it to occupy the unit for themselves. And this whole thing plays together. Later on, I will share with you the whole deep thought that was put inside this. So we've said it before, ideally you would like to sell to people that buy for their own stay, because there's going to be an emotional factor involved, and with that emotional factor involved, they are more willing to pay. Because if you really like something, you will pay for it, versus investors selling it to investors, whereby they are very, very focused in terms of getting the right entry price, driving a good bargain. Yeah, as simple as that. But what was one of the concerns that we had was the lack of good schools. So there's no good school within 1 km of Park Esta, so we sort of we weren't able to tap on that fundamental that helped us reap the reasonable returns that we did from 𝐜𝐴𝐿 lah. So, but you know, pros and cons we had to weigh, and we are comfortable without that lah, because another thing that you need to do is to be realistic. I think a lot of the times people are overly optimistic or overly have basically too long of a requirement, and in the end you are unable to find anything, because there's nothing that can tick all the boxes. There's nothing out there that's going to tick all the boxes. So you got to weigh the pros and the cons and come to an informed decision. Come to a decision. So what was not a concern? So the concern was a lack of a good school, but what wasn't a concern was the fact that it was 70% sold through. So for us, for those who follow us, for those who know us, we are fundamental based buyers. We do not subscribe to the whole FOMO mentality. Even though we bought 𝐜𝐴𝐿 on day one, we don't see a need to buy on day one. Fundamentally, the project has to make sense first and foremost. Your entry time, your entry price has to make sense. Your fundamentals have to make sense first and foremost, right? The buying, be it on day one, 1 year later, 2 years later, right? If the fundamentals make sense, that is not a concern to us. Yeah. I thought I would bring this out because I think a lot of people now are stuck in the middle, because conventional wisdom tells you that you buy a unit on day one, it gives you the highest chance to make a profit. But the fact is that the supply coming online would be the supply with the future price, versus the supply that is currently in the market is based on the old price. But the fact is that you've got to buy in at any development nowadays is likely to be 80-90%. So which one gives you the best value proposition? My answer is look at the fundamentals, look at your own plan, yeah, and do your own research. Don't just subscribe to the whole theory that you got to buy day one. So case in point, the guy that bought, right, I hope he's not listening, but if you're listening, I'm sorry. The guy that bought the 2-bedder at 2000 PSF, 400k more expensive than the dude that bought in day one over at Pasir Ris 8. I feel it's going to be quite challenging for him to yield good profits from that lah. So next part, let's go on to the unit selection. I think that's also something interesting for us to share. Okay, so we bought stack 12 lah. Sorry, I think you cannot really see. So let me read out to you. Stack 12, right? Our purchase price approximately 1.72 million. There is this other unit that is stack 4. There are 10 square feet smaller. They are 1023 square feet. So it was sold, right? They transacted at 1.6 million. So it's the same, basically the same layout. Just different facing, but the difference in price is 120,000. So I thought I wanted to talk a little bit about this because it's very different. Remember in Lake Grand we bought the cheaper PSF and we didn't buy into the developers loading, but in Park Esta we bought the more expensive one, 120k more expensive at that. So why? What's the thought process? Why would we do that? Because a lot of investors would usually say you just buy the lowest PSF, lowest entry price, correct? So story time again, yeah? So when we wanted to buy it, we wore the hat of basically the buyers that will buy from us in the future. And also because we may decide to move in to stay for a little while. So we wanted to experience for ourselves what was the noise level of the unit at stack 4 facing the road lah. So we did actual groundwork, walked the ground, and we realized that the noise level for stack 4 facing the road would be significantly louder than the unit that's facing on the inside. Then we asked ourselves that question, wow, this kind of noise level, if we own self-stay, can we accept or not? Because why? Remember we said we intended to sell to owner occupiers. So if we had only been wearing an investor hat, we would have picked stack 4 anytime because we would have constantly just been renting it out. That facing, if you want to continue to rent out, still not a problem. But if somebody is going to pay you 1.8, 1.9, $2 million for a 3-bedroom premium, they would make this choice. They will go down because at that point in time, so this is probably another learning point. A lot of the people, when they buy or as a new launch, they base it solely on the floor plan, solely on the per square feet. But when you sell out in the resale market, that buyer is going to come in and view all the units in the development and make that decision, basically opening the door, listening to the sound. The guy is already willing to pay, and remember, paying for own stay with a lot of emotions involved. So will that person pay $120,000 more to face the inside? We make the decision yes. So that's that, yeah. Then also the next point, we wanted to buy into a stack that was primarily owner occupied. Because of this analysis, I would not go into great detail. So this is an analysis that we do, basically measuring the break-even price of a unit if it's owner-occupied versus the break-even price of a unit if it's basically out on rental. So you do notice on the $1.7 million purchase, the break-even price for owner-occupied unit is $1.89 million. And a investor occupied unit that's out on rental, the break-even is only $1.75 million. So we also buy the inward facing stack because there's a very good chance that the bulk of the buyers that are buying that stack are owner occupiers, which is the only reason why they would pay that premium. So they will all have to be pricing their units. If we look at this chart at 1.9x 2 million, we are intending at this point still 50-50, right? We will tell you lah when part start TOP if you're going to stay in or not, but the plan is still 50-50. But if we do put it out on rental, our break even is only going to be 1.75 million 5 years after TOP, and that's going to put us at a significant price advantage over our neighbors. We will use them to basically pull our prices up. So if you want to do this calculation, we have the spreadsheet. We are happy to do it for our clients. Yeah, so drop me a text if you want to use this to have an idea on your own plans. So what is our contingency plan? So this is something that we want to talk about also because there is very different types of fear. There is a rational fear and there's also irrational fear. So a lot of the irrational fear with a big property purchase come about from the fact that people feel that it's going to be a extremely long-term investment and you are locking yourself in for a long-term 30-year mortgage, right? They get scared off because it's a 30-year mortgage and you'll be the slave to your house for the next 30 years. I beg to differ because I mean, what's the worst that could happen? Yeah, we are saying this from our own perspective, okay? If things don't go well, we can very easily rent it out and rent somewhere cheaper to stay, and with the difference in terms of the rental to just pay off the interest payments at least. Okay, so that's the contingency plan if anything happens. We keep the CPF for emergency fund, and that emergency fund is sufficient to pay the mortgage for a year if anything happens. Okay, so by staggering and putting your contingency plan in a very clear and concise manner, it reduces the fear from being a irrational fear to a more rational fear. Because if anything were to happen, if we were to churn through the emergency fund after a year, nobody will die go and hold on to the property, right? If you lose your job for 6 months, for a year, you're going to start thinking about selling your property and right-sizing it. So nobody has gone broke paying their mortgage. So all you have to do is, if you can't pay your mortgage anymore, sell the property, and you'll be able to sell the property and right-size and get yourself out of that thing, right? So there's always contingency plans, there's always a way around it. You buy it, it's not a 30-year, we don't see it as 30 years because we intend to flip it. Yeah, so that's that. So segment out your fear bring it from the irrational fear to the rational fear with clear and concise contingency plans with preferably actual figures lah in it. So next, right, so we have talked about the past, we've talked about the present, so what is the future? If we are working hard to achieve our goal, which would be a semi-D in the future. So I put this out to visualize source and credits to highlight architects that build fantastic landed properties. So that is the reason why we put it out here is not to Haolian, okay, don't get us wrong, I mean nothing to Haolian, we haven't even buy. It's to share with our listeners that don't be afraid to dream and don't be afraid to have targets in mind, right? And then your property plan should have that long-term target in mind, and then you work backwards to try to achieve that target. A lot of the times what people do is they just take one step at a time, right? Focusing on your current needs and requirements, and then leave the fact of being able to reach your final goal to chance. So no, you don't have to do that, right? Work your way backwards, and the main thing is the intermediate steps, first of all, the plan will become a lot clearer, and second of all, you prevent yourself from making decisions that you will regret. Okay? So, I think I skipped past one of the points in terms of the mindset, because I'm just going to come back into it. Yes, on how we plan. So, this chart on this picture on delayed gratification. So it's something that we really use for ourselves. It's very clear what is our long-term goal, and we are willing to take the necessary steps, the necessary troubles in between to hit that goal. And thankfully, we've seen more and more families, clients, couples choose to take this step of delayed gratification and living with a little bit of inconvenience to hit their goal in the future, which cannot be said actually in 5 years ago lah. So which is really why we wanted to do this very upfront and transparent sharing, because we wanted to put it out there and share with our clients that do always put in a goal, dare to dream, have that long-term plan. So right, we are ending off soon. I'm going to tips. So what are some of the tips to plan your property purchase? So have long-term goals in mind, right? Don't be afraid to dream, especially if you know your earning power is going to come up. You're going to be expected to hit that earning part, that sort of income eventually. Because another painful thing that we notice with a lot of clients that we speak to is that their income and their purchasing power have came up, but they are stuck in a property that is cannot sell, number one, or don't want to sell, because if sell, will have to make a loss. So it then becomes a very emotional thing versus a very logical thing. Yeah. So always have long-term plans, work backwards, so you don't do something that you regret, and you always be able to keep yourself on track and track that you are on track to hit your goals lah. Right, then from there you can have a very systematic plan. Use the template that we have. Set target goals on when you are looking to sell, how much you're looking to sell at, who you're going to be selling to. Okay. The next, third and fourth point is logic and emotions. So logic is very straightforward. Okay. Logic is facts and figures, research, knowledge. So you're doing a good job if you're listening in to us. So that settles the logic part. Like I said, knowledge is the antidote to fear. The more knowledge you have, the lesser fear you have. The more knowledge you have, the more clarity you have to the future. So the third, fourth, fifth, and sixth point, right? Emotions, mindset, and communication is actually, I would say, in the discussions I have with clients recently, it's actually more important than the logic part, the knowledge part, because data and sharings like that is very, very common in the market at this point in time. You go to YouTube, you find tons of videos sharing with you market knowledge. But then again, right, why we are choosing to do this is because we are talking about something that is not so much discussed in the public forums. It's the mindset and emotions part to a property purchase into an investment. So we talk about things like delayed gratification, long-term plans, daring to dream, working your way backwards, having the systematic plan involved. So having all of that, right, reduces the whole emotional factor that actually impairs and prevents a lot of people from making very good and logical property purchasing decisions. So the mindset has to be correct. A big fear that I have today is overly aggressive strategies. If you are purchasing a property with a fixed exit time, so like I said, even though I'm planning to exit 2025, 2026, if that is not a right time, I'm perfectly able to hold it. I'm perfectly able to manage around it. Similarly with 𝐜𝐴𝐴, if the prices wasn't right, we wouldn't have sold it. We would have been perfectly comfortable continuing to hold it. I have spoke to a lot of people that have made very, very drastic bets into the property and going through really a lot and having basically a big, huge bet that it will turn out well in 3 to 4 years. I honestly wouldn't recommend that. Again, property is not the most liquid of investments, so it's always good to have the right mindset entering a property purchase. Anything shorter, it's a bonus. If not, be more than happy to go in the long term. Okay, so communication matters. So this is communication between you and your partner, you and the other stakeholders in this property purchase. It's always good to have a common goal in mind. So for those of you who have trouble agreeing with your spouse, with your partner on what is this next purchase, right? A good suggestion is then just pull yourself out in a more macro perspective. Take a look at the long-term goal and at least agree on the long-term goal. That one is probably a lot easier to agree upon than the short-term goal. Agree on the long-term goal and then work yourself backwards. It has helped our clients gain a lot of clarity and be really able to have that property plan in place to take action well. So communicate, right? Communicate on your goals, on your plan, on your long-term goals, okay? If you have trouble with that, you can reach out to us, because we have also clients that say we end up acting more or less like a counselor to bring the needs and requirements together. So while we are not licensed counselors, we have dealt with that a lot, which is why we are able to come up with tips like that. So for those who follow us, you know the way we think is a little bit different from the traditional thought process, which is why we have done our book, the Contrarian Property Strategies. This book is already done. So I apologize again for being a little bit slow on the books that we thought about previously, but this book is already done. So if you want to take a look at it, want to read it, understand what are some of the contrarian views we have with regards to the property market, right? Drop me a text, put in a comment, and we can send it to you as soon as we can. So how can we help, right? So you have learned how we do our purchases. You have learned what are some of the tips we have with regards to planning for a property purchase. So if you like for us to help you further, so these are some of the things that we do before a purchase. Like I said, it's actually the before part that is the most important, and that you should be spending the most time. And also because the market is moving so fast at this point in time, there's a lot of FOMO in the market. Always take a step back and do your whole plan well, because it's also in FOMO markets that people do things that they tend to regret later on. So spend more time on this, right? These are some of the things that we'll do. You can go and read up on it. I won't speak out on the points. The purchase part is actually a lot easier. So it's like what we said just now on what to do during the purchase, forecast, predicting who is going to buy from you later on, those parts. Actually, the purchase itself is quite straightforward once the planning is done well. And it's also the after that we notice is lacking severely in the market at this point in time, is the after sales service. Continuously updating our clients on the critical market updates, what has changed in the market, are we still on track to achieve our long-term goals? If we are not, what can we do in between to tweak and to get us back on track, right? To make sure that the predictions, the projections, the forecast that we make before the purchase and during the purchase is actually working out. And if it's not working out, what are some of the remedies and what are the steps that we can take to remedy that? Okay, so that's about it, right? Today's sharing quite long, huh? Wow, 1.5 hours. Do we still have people listening in? Yeah, okay, anyway, thank you so much for joining us on this session, super duper long session. But you know, all of this wasn't really scripted. Like, it was really just sharing what I thought could benefit our clients. So, do we have any questions? Yeah, we do. Let me go in and get the questions. Give me a minute. Where? From Chloe, is it? Can you see? Okay. So Chloe, were you concerned about tenant profile for purchase at OCR? So Chloe, oh Kit, hi Kit, our good neighbor at Park Esta, right? Anyway, yes, were you concerned about tenant? Not really. So maybe a sharing on my tenant profile at Park Esta. My first tenant was a corporate lease, because they were working in, the guy was working in the oil and gas industry lah. So came circuit breaker, terminated the lease to leave. We got a replacement tenant almost immediately. Our replacement tenant is a Korean lady with her son. Yeah. When we got our keys, the demand for the rental was very high because of the international school in the vicinity. So if you're buying the OCR for investment, actually not much to worry about. Basically because, right, you are getting an extra room in most circumstances. CCR versus OCR, or even RCR versus OCR at this point in time is almost like a 2-bedroom investment versus a 3-bedroom investment. That extra bedroom actually can bring you result in a balancing off of the rental yields, so to speak. And the tenant profiles are actually pretty alright. If you are concerned about it, you may want to pick a property nearer to an international school. That will help a lot in your tenancy and your rental. We have done a lot of sharings in the past showing how do you pick the right properties based on existing market knowledge, right? You can check out some of those videos. Okay, do we have more questions? Just one? Okay, Ken, thank you so much again, everybody, for joining us. If you want a copy of anything that I have shared, drop me a text, drop us a DM. And till then, right, till the next sharing, thank you so much. Bye-bye.